Well, good morning to the West Coast, good afternoon to the East, and good day to everyone else in between, which actually, now that I think about it, nobody is in between good morning or good afternoon. So just hello to all of you. As we continue to spend time together electronically during the COVID crisis, it is a pleasure to at least be able to have these conversations with ideas and concepts to share with you. My name is Brad Etheridge, and I'm the Chief Marketing Officer. Most of you know me. To the new members, you only know me electronically. But welcome, we're glad to have you here with us. We're going to take a little over an hour today together, and if we end up going into some additional questions, we'll stay with it as long as you stay engaged. And we're going to share some ideas and strategies. For the new members, we'll even spend a few more minutes talking about a couple of the other benefits that you have within your membership. That may be a refresher to the existing. But we will leave the lines open so you can electronically ask questions. For those of you that are not yet familiar with these types of meetings, you know you can move. If you want to make your screen larger, you can shrink down or expand those pictures of Simon and I and get us out of the way if you so choose. So feel free to kind of play with that a little bit, but don't lose the content of the meeting and spend too much time on that. For you new members, I have the honor, and for the existing members, the honor of reintroducing our founder, Simon Stuffy Singer. He's the founder of the Advisor Consulting Group and has been in our industry since 1966, quite successfully, I might add. A bunch of business bestsellers and is a national speaker. And on his speaking circuits now, we get to include some of these national speaking engagements are electronic. I know, Simon, you just had a couple of really large ones over the last couple of weeks with Struzarian Company. And as a result of that, it's nice to be able to at least get as close to face-to-face as possible. We will get through all this together, and we're, again, very happy to have the time with you here today. Simon's also a member of Advisors in Philanthropy, past president of the International Forum, and the probably his largest honor, which is amazing. To be able to say, and I'm trying to remember what that honor was. Simon,
that is amazing, Brad.
Yeah, whatever it was amazing. I mean, people are still talking about it today. In fact, you probably know what it was called.
Yeah, I do, but I'm not going to help you actually.
All right. Well, in which case, later in the broadcast, I'll share with you what that honor was as soon as I can remember. All right,
I like this. I'm supposedly the old one, Brad, not you.
I think I've got COVID brain. I'd like to turn this over to Simon Singer before I make it any worse, and then let's have some fun on our subject, a discussion of goals, objectives, and discovery. Simon.
Thank you, Brad. Appreciate that. We're going to talk about a subject today. The title, you'll notice, says A Discussion of Goals and Objectives and Discovery, because our feeling is, and the feeling of most of the really top producers in the country is, that our industry doesn't provide any training in this anymore. It's not just numbers on a page. It's not just somebody's date of birth and their wife's name and their kids' ages. There's much more intangible stuff that creates a level of emotion. And for those of you that don't know this, people don't make decisions logically. They make decisions based on emotion. They verify with logic. So you sit there and throw a ledger page in front of somebody and expect somebody to make a decision. You're missing the major point, which is what's going on in their head and their heart. And there's a lot more going on there than there is in their pocketbook. And all our industry trains is about pocketbooks. So saving taxes is important, protecting assets is important, but you got to find out from them what's important and why it's important. So that's what we're going to kind of go through today. And if I can work this machine, we'll see what is the difference between goals and objectives and data. A goal and objective, I can't figure out how to do this. A goal and objective is is a destination. So you can equate that to taking a trip. I want to get to New York City. An objective is a measurement of the progress that's needed to get to that destination. All data is their name, address, and phone number and their financial information. It has nothing to do with their needs, has nothing to do with their wants, it has nothing to do with their goals. So it's really important to get in between the lines. For instance, I don't need to have a meeting with somebody either electronically or face to face in order to find out how much money they make. If they're willing, all I need to do is get a copy of their tax return. I don't need, I can get a financial statement to find out where their assets are and what their liabilities are. I can ask them on the phone what they need to maintain their lifestyle, but it's not getting to the heart of the matter, which is the goals and objectives in great detail. So this is an example of a sheet that we utilize. Members, you can get this off the website. This is a general sheet of goals and objectives, and it's nothing that you don't know. So, you know, what do they need to maintain their lifestyle, and do they want to provide maximum inheritance and efficiency for their children and their spouse's inheritance? But all the way on the right-hand side, it says priorities. I typically want folks not only to list the goals and objectives, but I want them to prioritize those goals and objectives so that we can take care of the most important things first and then progressively take care of lesser and lesser important things. I'm hoping that concept makes some sense. But so, for instance, one of the things about questions, which I'm a big proponent of, is the fact that it leads to another question. So while they're going to answer these goals and objectives, although I will tell you, I had one doctor client who said, why are you giving me this thing? I mean, obviously, I want to do all these things. But he missed the point about me wanting him to prioritize those things, because it's not unusual for people to have goals and objectives that conflict with other goals and objectives. And conflicting goals and objectives can act very similar to two very valuable medications, but when put together can cause a disastrous result. And the same thing can happen in financial, tax, and estate planning, is we don't want objectives to mix and match and cause a bad result. So, for instance, produce maximum efficiency for your children's inheritance. He's right. Who wouldn't want to do that? But I need to know whether that's as important as being able to prioritize, number one, maintain their current lifestyle. So in no particular order, we basically give something to them like this. We'll eliminate some of them. We'll customize it depending on facts and circumstances. But for instance, attracting and retaining and motivating a key employee is of no relevance to somebody who's retired. Compensating a shareholder family, and in the event of a shareholder's passing, has no relevance if they're no longer in business. So we can take things out and we give them instructions that we want you to take out and add goals and objectives that are important to you. If we come over here to the other, we want their input, but most importantly, we want them to sign off, we want them to date, and we want them to prioritize the goals and objectives that are suitable for them so that they can give us a roadmap as to what it is that we're trying to accomplish. Now, it's not, by the way, I would like a husband and wife to do them separately. When I get them back and I see all of them are identical, I know that one of them, likely the husband, is the one that did it. I will tell them to take it back and do it correctly, because it's important to get the spouse's input and her priorities as well, not just his. We get battles on that. We also get battles with people who might put everything down as a number one priority. That means they took about 30 seconds to do this. That's not good enough. I want them to take the time to give us the direction, because if I equate it to somebody going on a trip, I might say to them, all right, you've decided you want to go to New York City. When do you want to go? How long do you want to stay? What mode of transportation are you going to take? Are you going to drive? Are you going to hitchhike? Are you going to go by bus? Are you going to go by train? Are you going to go in an airplane? And if you're going to go on an airplane, what class of service? And when you get to New York City, how are you going to get to your hotel? What kind of hotel are you going to stay at? What kind of a room are you going to do? What kind of activities? Are you going to go see shows? Are you going to go to the ball game? The more detail that we can get into those goals and objectives, when we come back with the recommendations, we can attach those recommendations directly to a goal and objective that they told us was important to them. I hope that makes sense, because I can't tell you how much larger your sale can be, how much greater your closing rate will be by spending the time in the foundational issues of creating financial and estate plans. It is monumentally important, since we all have the same products, since we all have the same strategies, and we all have the same tax law. I hope you believe me, the intangibles are what make the difference. It's not that I've got this new, better product, because we're not going to know which is the best product until we're 40 years down the line looking backwards. Then we could look at it and say, that was the best product. So our responsibility is to get a good product or a good asset allocation. Doesn't make any difference which, but it's this interviewing technique is so incredibly powerful that it will give you so much, it will allow you to have so much a better meeting that I can't even begin to it. So that's what we're going to try to go through, and we'll show you some examples. We'll show you some results. We'll have some conversation back and forth. Oh, by the way, one of the things that the goals and objectives also does that makes your malpractice company very happy, because you have very specific reasons why you made a recommendation and what direction you were getting from the client. And especially if you're dealing in the elder world, people over 70 years old, that's going to be very important, because as you all probably know, there was an annuity salesman who I read the case, appeared to do a very good job and actually went to jail for, quote, financial elder abuse. So this is really important to protect yourself, protect your client, be able to give a family member an answer as to why you did X, Y, and Z. So it's important. It's really important. And these other columns over here, I mean, I've had a client tell me, this is my second wife. She's had a good ride. I don't really love her. All I want to leave her is $100,000. And when I told the referring CPA what he said to me, the CPA was aghast at what his attitude was. So it's important, really important, to be able to cover your client, cover your client's errors, and cover yourself, and you will be able to accomplish much, much more than you might have ever dreamed of. Does that make any sense? Brad, you got anything to say?
Yeah, actually, there is so many things. I think we could do, 4 hours on the psychology behind collecting goals and objectives. What I'll tell you, when we have somebody who first joins the Center for Tax Strategies and we ask them if they're asking for help on design for a case, our first question is, where are you at with the goals and objectives of the client? And Simon, what do we always get when we ask for that?
Oh, yeah, I've got all of it. And the reality is, they've got a name, address, a phone number, and a net worth statement.
Yeah, exactly, which is important to have, and it's part of the phase, but it doesn't help you with the psychological aspects of understanding what the client thinks, what wakes them up in the middle of the night. The other thing, too, is what's always really telling is the difference between the spouses in regards to their priorities, because it's a wonderful way to be able to get that out on the table. We were doing a goals and objectives, I think we shared this a couple weeks ago with a client, using this electronic medium to view them, and watch the wife punch the husband in the arm when their numbers were different on their fact find. So I think we found a pain point, which was his arm and her upset that he wasn't taking care of that problem. The other thing, too, that this is really, really helpful for when you go through it, assuming you don't find a lot of conflicts in their answers that Simon already talked about, either answering too quickly or identically with the spouse, this is a wonderful way to stage how you're going to set up your second appointment with the client. Because I want them to know I listen. I want them to know I understand their issues. I also want to do things in an order that helps me to close. So picking their priorities on a recap of what we talked about last time we're together really allows them to know that I have an insight in regards to what their issues are, not just what product I want to put in front of them. Make sense?
So thank you. So when they give this back to me, it's almost always wrong. But when they give this back to me, I start asking for clarity. So for instance, provide for an equitable distribution of assets upon your death among your children. What does that mean to you? Tell me what an equitable distribution means. And typically they'll say, well, I want to treat them equally. Then I will ask them, well, tell me what your definition of treating them equally is. Well, I want to take my assets and I want to divide them in thirds, assuming I've got 3 children. So what you're saying to me is you want to take your automobile and have it cut up into thirds. You want to take your business and you want to have it cut up into thirds, despite the fact that only one of your children is involved in the business. That child has been in the business for the last 20 years, and one of your children is a school teacher, and one of your children right this minute is a drug addict and in jail. So you're telling us that you want to take and divide and then they go, well, no, that's not what I mean. So this question after the question after the question is incredibly important. And you can sit there and say things like, I'm not trying to be cavalier. I'm not trying to be abusive. I'm trying to understand as well as I possibly can. And usually they haven't given it a lot of thought. And so it's the right asset to the right person in the right amount at the right time, and asking questions after questions after questions. So reduce onerous taxation on your IRA. Well, tell me what you think the taxation is going to be. They might not have any understanding, but at best they will say, well, I'm going to have to pay income tax on my distributions. And I'll say, is that all? And they'll say, well, yes. And I said, well, how about your final tax return after you've passed away? They're going to have to be taxes paid on that. And they'll go, huh, I never thought about that. Yes, I guess taxes are going to have to. And how about if your estate is in the estate tax zone where there's another tax to be paid? How about your estate tax? So in today's world, where we got a $24 million lifetime exemption, not a lot of people fit into that category. But if you run into somebody that either fits into that category today or is very much aware that January 1st, 2026, the lifetime exemption is going to go back to where it was prior to 2018. And some of us believe that when the Democrats get into office and control Congress and the presidency, that you're liable to see that lifetime exemption drop to 3.5 million, where today it's about 11.5, actually almost 12. And the estate tax percentage is 40%, and that's very likely going to go back to 55%. So you can help people understand things that they think they understand just by asking them more questions. Don't lecture them, just ask them the question. What do you think is going to happen to taxes? Do you think they're going to be larger? Do you think they're going to be smaller? Do you think they're going to stay the same? So you can help them process without lecturing to them. Brad?
Yep, no, 100% right. Just keeping them on the same page in regards to the conversations, what moves the conversation forward that allows you to get to the next level. So
yep.
We can't, it sounds like we beat up on the swarm every time we talk about it, because it is so critical to the sales process psychologically. It's also a lot of fun. I mean, when you're talking in order about things that are important to them, you engage. And when you engage, then they feel you have an unbelievable understanding, unlike the last 5 people they worked with, in regards to how to deal with their circumstance, and it builds credibility.
What's also interesting about that, Brad, is that when they change their mind, when they start to have buyer's remorse, you now have a roadmap to go back over with them and say, look, this is your plan. We'll do anything you want, but let's go back through these goals and objectives and let's see what's changed. Usually nothing has changed. Usually what's happened is they start focusing on the cost, which might be attorney's fees, additional accounting fees, our fees. It might just be time that they forgot what they talked about and what their goals and objective was. You can almost always bring them back to the table in the same place they were with yeah, I forgot about that. Yeah, you're right. Let's just keep going forward. So here's an example of goals and objectives as defined by a specific client that we had. So it's always important. You notice these little lines over here. That's where I want the priorities to go, I think. Let me just do this for a second. That's where I want the priorities to go. Current lifestyle, they almost always will give me a wrong number. They will give me a gross number as opposed to an after-tax number. They will give me a number that includes a cushion for where they would like to be as opposed to what their current lifestyle is. So it's an area for me to be able to review with them and check and make certain that we're on the same page. Because if we're solving for an after-tax number and they give us a pre-tax number, the amount of money that they need in retirement is going to be significantly larger. I need to get clarity with that. So it's important to communicate that thing. Maintain control money of monies that would otherwise be lost to tax. That's one of those, well, of course I would like to do that. Provide for equitable distribution of assets upon your retirement and upon the death, assets upon your death among your children. That's that equitable distribution again. So the reason I'm going through this again is this is a real client. This is a client that we did a pension plan for, we did a type 3 supporting organization for. However, his net worth went from about $5 million when we started to about $150 million when we started this second engagement with him, and ended up with moving his qualified plan money to his family foundation, which was about $4 million, ended up with about a $375,000 life insurance done with qualified plan money outside of the taxable estate. So this was a whole new engagement, even though it was the same person. Provide for equitable distribution of your assets among your death among your children. He has one son that has been in and out of jail with regard to drugs, in and out of rehab, tried suicide any number of times. That's the last child that he wants to leave a lump sum of money to, although he certainly would like to take care of him. Reduce the taxation of your IRA, reduce taxes, estate taxes, maximum value of your estate to children, protect assets from the claims of judgment creditors for you, your children, and your grandchildren. I know that some of you talk to people about doing asset protection. And what we usually get is we get, well, you know, I'm retired now. I don't need any asset protection. I've got my homeowner's policy. I've got my property and casualty insurance on my building, and so forth and so on. If we ask them about their children and ask them if it's possible that at some point in time their daughter might get married, they will answer yes. And do you think it's possible that if she marries that tennis bum that you never wanted her to be associated with to begin with, and is it possible they might get divorced? He'll say yes. And we'll say, well, the asset protection we're talking about is not just you, but it's your children and your grandchildren and your great-grandchildren, because if we set up structures correctly, they will never be community assets. And all of a sudden, the temperature in the room changes, because now we're talking about things that are important to them, and people don't buy, people don't engage unless we can help them figure out what's important to them. And that's what these goals and objectives are for, but it's the conversations in between the lines, much more so than what the actual question is itself. Retain control of your assets, who doesn't want to? However, when you do proper estate planning, they're going to give up a certain level of control. They need to understand that by setting up a series of trusts or corporations or plans, that they're going to have to pick the proper trustee. They don't like giving up control. They can understand that they still have the right to change trustees. The objective is to pick somebody that's competent, that is cooperative, and will pretty much do whatever they want to do. And they retain the ability to be able to change trustees if they want to. And if for some reason or other they're not around, there are things called protectors to the trust, whose sole job it is to fire the old trustee and hire a new one if they're not being completely and totally cooperative. Provide more clarity. Most people don't have any idea what's in their documents. Absolutely none. When we review with them, they'll say, well, I didn't know that. I never thought of that. I don't want to do that. Or maybe things have changed. Reduce income taxes. We'll talk more about our tax reduction plans in a while. But I just want you to see what this one particular client was going through. More involvement with exploring philanthropic planning options to meet your short-term and long-term goals and objectives, and philanthropy versus taxes. The Internal Revenue Code provides incentives for people to be voluntary philanthropists using the charitable system, as opposed to involuntary philanthropists, and have it run through the tax code. So most people don't understand that they have a choice. They think that philanthropy has to mean that I'm giving things away. That makes me poorer. That means I disinherit my children. That means I can't change my mind. But there are ways to be able to use philanthropy in a very intelligent way where none of those things are true. So let me keep going.
Hey, Simon.
Yeah.
That was spoken very much and very true to form for someone who's received the Humanitarian of the Year award. So thank you for that.
Who was that?
That would be you, Simon.
Oh, is that the award you were referencing earlier? Thank you.
I've said it so many hundreds of times that it emotionally hits me every time. You know,
I
you were the recipient. You were the recipient of the Humanitarian of the Year award, right?
Yeah, for the Forum 400, yes.
Awesome.
Not for the award. Yeah.
Thank you for sharing. Thank you for sharing that.
Brad, would you repeat that again so our audience can hear it and kind of
Which part, the Humanitarian of the Year award recipient?
I'm going to the next slide, Bradley. Okay, here's the strategy matrix. And these are all of the potential things, and I'm certain that I've missed a few, but these are all of the potential things that a client might consider. Family limited partnerships, corporate general partnership, heirs trust, pension plans, qualified personal residence trusts, grantor retained annuity trust, self-canceling installment notes, sales to intentionally defective trust, self-canceling installment notes, grantor retained annuity trust, private annuities, testamentary charitable lead trust, enhanced charitable lead annuity trust, pension rescue, create family harmony, enhance family harmony. I'm not quite sure what the difference of that is. Charitable remainder trust, grantor charitable lead trust, life insurance, irrevocable insurance trust, premium financing, split dollar, philanthropy versus taxes, guaranteed retirement plans, a family bank, sale of a limited liability company interest to a grantor trust, private retirement trust, Nevada self-titled trust, California limited liability companies. I want to see something because I think, okay, so we reviewed those. We reviewed those with the client. Most of them were not appropriate. We then went to the next phase, but the key here was to let them know that we're not hiding anything from them. That's the first part. The second part is we want to make certain that we have a certain level of discussion. So when, not if, when they talk to somebody else, another insurance guy, another attorney, we will have shared the fact that all of these things are available, but we don't necessarily think that all of them are appropriate for you. So they won't get a surprise and say, Simon didn't tell me about that. I wonder why. So we try to minimize the chance of losing our credibility. Here were the ones that we actually discussed in detail. Complete his existing estate plan. He didn't have his documents completed. Look at a grantor retained annuity trust, which he hasn't done yet. Qualified personal residence trust, which he has done. A grantor charitable lead annuity trust, which he hasn't done. The sale of a limited liability company interest to grantor trust. Well, he was retired now, so we didn't have to do that. Charitable remainder trust, which we did do. Private retirement trust requires him to be employed, so he's no longer employed. Nevada self-settled spendthrift trust, that's an asset protection vehicle where he can actually be the beneficiary of the assets so he can keep the money away. Remember I said he had a son that had a significant drug problem and was in and out of jail? Well, since he's still providing the majority of support, if the son does something of a very onerous nature, commits a crime, kills somebody, we're trying to protect the assets from the supporting parent, which was the father. California limited liability company, insurance analysis, which we did, premium financing, which we did not do, family split dollar, which we did not do, testamentary charitable lead trust. So it's taking the whole universe of strategies and then breaking it down into bite-sized pieces where we can spend more time and help in conjunction with the attorney and the accountant, by the way, both of whom were involved every step of the way, the attorney and the accountant, and get a commonality of purpose and get a uniform set of recommendations. So when the client turns to the CPA when we're not there and says, what do you think? Or turns to the attorney and say, what do you think? Or turns to us and says, what do you think? We're all on the same page. We're all making the same recommendation. That's a piece of information that will stop these professional advisors from being deal killers and have them become deal makers. It's a big deal. Once we show them that we know what we're doing, once we show them that we respect what they do, once we show them that we are not stepping on their toes, not embarrassing them, and getting them paid, all of a sudden the temperature becomes completely different in the room. Brad, you got something?
Yeah, take a second on that, Simon, because though we've talked about it before, it's a critical point. You know, one of the things that I picked up from you, and I know you've done for your entire career, is letting the prospect know early in the process that part of your process is you are going to need them to introduce you to their CPA or tax attorney, and that you want to have an opportunity to spend an hour with them or an hour and a half or whatever it takes to go through just one-on-one. And I know the reason you do it, and the reason you do it is pretty clear. You don't want them to be in a threatening position where they have to defend what they haven't done for the client. Correct?
That's correct.
The other thing too, and the other reason you do that is not just the deal killer aspects, but you've built a tremendous career off the backs of those CPAs and tax attorneys because you did approach them properly. They now are referring you to their client base because they know you're going to make their job easier, make them look good. Is that also true?
Well, it's partially true. I didn't come out of the womb knowing how to do that. I started my career in trying to avoid the deal killers because I was getting stepped on almost every time. And I would pray that the client wouldn't say to me, can you talk to my attorney about my accountant about this, or give me your proposal and I'll send it over to them and see what they think. The last time I made that mistake was 1984 but it was a monstrous mistake. I was right on every single recommendation that I made, and the client said to me, well, if it all works like this, how come my attorney and my accountant haven't told me about it?
Right.
And in my infinite wisdom, being, in my early 40s, in my infinite wisdom, I said, don't ask me. I mean, they know the law as well as I do. Maybe just I'm applying it to your situation better than they are. Without realizing it, what I just had done is I had embarrassed the attorney and the CPA. However, the attorney and the CPA had a way of getting back at me. And the way they got back at me was to agree that everything that I had recommended was absolutely right and they should do it all. But there was always something a little bit wrong about something that I had where they could do it a little bit more efficiently. Had I not embarrassed the attorney and the CPA, had I had brought them into the mix and allowed them to be part of the planning process, that was a $750,000 commission in 1984. That's what, 40 years ago, 45 years ago? That's probably a couple of $1 million in today's value money. But I will also tell you, had I not made that mistake, because I was very depressed for a couple of months until I finally realized that it was my fault. It wasn't the attorney's fault. It wasn't the CPA's fault. It wasn't the client's fault. I kept getting accolades as to how brilliant I was. Wasn't that brilliant? But what I didn't understand is that I had either an adversary or an advocate. And if I'd have spent the time, which I've done now since 1984, if I'd have spent the time gathering the information, not been so quick to make the recommendations, didn't make any difference whether my recommendations were right or not. Taken that information, asked permission to be engaged to talk with their attorney and their accountant, and then shared with them the information and asked them what they think we ought to do. And if they didn't have any suggestions, start to make my suggestions. What would have happened is they would have seen that I was a team member, not an adversary. They would have seen that I was respectful of their position, that I wasn't going to embarrass with them. And oh, by the way, they would also get paid. I would have walked out of there with a very substantial case. Even in today's world, that's a substantial case. But there was every single piece of that engagement that was set up perfectly for people in our business, and I screwed it up. And I'm suggesting that most of the people in our audience, most of our members, tend to screw this up by being too anxious to make the recommendations, by being too anxious to exclude the professional advisor. And it was a monstrously benefit. It turned out to be the best investment I ever made by losing that case. And by the way, that individual happened to be a client of the ever famous Ben Feldman. And I was told continuously how much more I knew. And I kept thinking to myself, well, I might know more, but Ben still has your money, and I don't. It was a horrible experience, and yet an incredibly beneficial experience all at the same time. So I'm trying to prevent people in this audience from making the same mistake. In other words, gather the information, slow down, stroke your chin, and say, very interesting set of circumstances. I think there might be some ways to maybe save you $100,000 or $200,000 a year in tax. We can get rid of that $4 million of retained earnings that you have in your C corporation. I think we can figure out some ways to pass assets to your kids without having them double taxed. And he would have said to me, well, how are you going to do that? And my answer every single time is, it depends. And he says, depends on what? I said, it depends on facts and circumstances. All I know is there's probably a half a dozen different ways of doing this. Do you have an attorney? Do you have an accountant? I'd like your permission to be able to share this information with them and see what they think, because maybe there's some things that I missed in between the lines. He would have willingly done that because he gave me permission to go talk to him anyway. The difference was he gave me permission to talk to him after I had already embarrassed him. And there was no way that they were going to say, this kid from Los Angeles is absolutely right. We've been ignoring you. It's our fault. We should do everything he said. And I'm just... It would have been so simple, and it's been so simple ever since. But wow, what an event! What an event! Every time I fly anywhere near this particular small city in Ohio, every time I think to myself, I know I can get him this time. I mean, I must have been back there 5 times in the initial phase and got nothing. Probably had $10,000 out of pocket, and then 5 years later, I got a call, and the call was this man, and he says, that pension plan you got me into. And I'm thinking to myself, I got you into. I made the initial suggestion, but you didn't do it with me. They use a firm called Conahan and Conahan in Hawaii, and they were charging in 1984. They were charging $25,000 to set up and validate a defined benefit pension plan, and the attorney layered some fees on top of that. So now he's saying that pension plan that I got him is causing him problems. I said, what are the problems? And he said, well, now there's, in addition to income in respect of a decedent and estate tax, there's also this excise tax. And now what's going to happen is my family is going to lose about 93 cents on every dollar that I've got inside this plan that you had me do. And I'm aghast because I didn't have him do anything. So I said to him, well, what did Paul say you ought to do? Paul was the first name of the attorney. And he said, well, Paul told me that what I should do is buy low yielding investments, and that'll reduce the tax. And I started to laugh. He said, what are you laughing about? I said, well, based on that piece of advice, maybe what you should do is buy investments that lose money every year. That'll reduce the tax even further. I thought that was hysterical. He didn't think it was that funny. So he stopped. There was this long pause, and he says, oh, I see what you mean. When can you get out here? I'm on another plane, another 5 times, another couple of years, another 0, because I could never overcome that simple screw up that I did by making recommendations without the approval of the professional advisor. That's a painful story.
Well, you look, and I know, but sometimes those painful stories are the ones that resonate with you, and it put a good trajectory on your career path. I want to point out though, this going through the strategies, the goals and objectives, Simon, I would lay out, now that was a complicated case, right? But there's a problem when it's a non-complicated case that this helps you through also. One of my very best clients, who's probably one of the smartest people I've ever met, referred me to somebody who also thinks that the client was the smartest guy he ever met. And he said, I saw what you put together for Matt, and I'd like you to do the same thing for me, but I don't have $300,000 a year, but I have 50, and I want the same thing. Best lead I've ever had, so I thought, and I went and I skipped protocol. I went in and I said, okay, so you said 50 works for you. Let me show you the program works. And I went into the solution phase and the product. I didn't do the discovery. I didn't go through any of the other steps, including goals and objectives, because it was a lay down. I didn't get the case. And I kicked myself every time I thought about it ever since then. There is so much more I could have done. There was no reason that case didn't get done, but because it was such a good lead, and it was such a perfect set of circumstances, and he respected the referral. So, keep in mind that these procedures are not just for these super complicated cases like what Simon was talking about. It's for every case. You can't ignore, you can't skip a step and expect to have better results.
And you also can't think that you know what the client is thinking. You can't get goals and objectives from their CPA who tells you, I know everything about these people. It doesn't work like that. There's a building of relationship that's necessary. There's a building of credibility that's necessary. There's a building of confidence that's necessary. There's a building of process that's necessary. You've got to control every single piece of it. We've got a saying, you got to control the controllables. And not everything is controllable, but there's a lot of things that are. I was in control as to when I talked to that attorney and when I talked to that accountant. I was in control as to when I made those recommendations at the very first meeting I had with an individual that I never met before. I was in control of those things. I gave up control. And once again, it was an amazing learning process. So let me show you the results. I believe is going to be the next slide. Let me show you the results. This one's different. Okay. All right. This is a case study of an ophthalmologist, and we did this up. You're not going to be able to read it, but on the following slides, we're going to go through each step to show you what the goals and objectives was, to show you what the problems were. But this kind of looked pretty. We've handed this out to the members at previous meetings. You new members don't have this. You can get it. All you got to do is ask for it. All right. So here's a 40,000-foot view. An ophthalmologist was an acquaintance of mine. He was complaining about saving for retirement. He had a know-it-all CPA, because when I brought up the concept of doing a defined benefit plan, we're talking about in the early 1970s, he said to me that doctors can't do defined benefit. And no matter what I said, it wasn't going to go through that. So I called the tax attorney, had him get on the phone, and all of a sudden, the doctor was allowed to do a defined benefit plan. By the way, this accountant had about 3,500 doctors as clients, but it was a battle every step along the way. So I was smarter, all right, but it was still a battle. So the presentation, we're going to go through the sales plan, the results that the doctor had because of the interaction. Because remember, this never would have happened without, well, let's see, I don't know what I did there. I can't see magnify, Todd. Oh, well, I got it back. I just clicked escape. So here were the overall goals and objectives. Reduce current income tax, protect assets from the claims of judgment creditors, fund for retirement, purchase a vacation home for $400,000, protect family in the event of death or disability. So I can protect assets with the defined benefit pension plan as long as I've got more than one employee, the doctor. I can reduce the income taxes by putting money in a defined benefit plan. By the way, the asset protection, think O.J. Simpson with a $33 million civil judgment against him by the Goldmans, and he has two defined benefit plans, one from his football career with the NFL and one from his acting and commercial career. And the Goldmans, even though they wound up with a $33 million civil judgment, could not touch any of the principal, could not touch any of the income, could not touch any of the investments that he made with the income. So he's got himself about $400,000 a year in retirement income. It's taxable, but about $400,000 a year of retirement income, and he's got a $33 million judgment sitting on his head. Fund for retirement, purchase a vacation home for $400,000, and protect family in the event of disability. So those are goals and objectives. Here were the strategies that we used. We created the defined benefit plan. We used a split dollar life insurance policy in order to do two things. In order to reduce the taxes, since life insurance is not a deductible event, but a C corporation at the time, just like it is today, is taxed at a much lower rate. I think at that time, the C corporation tax on the last $50,000 of corporate profit was 15%. Today, it's 21% across the board. That's significantly different than an S corporation or W-2 income, which can max out at 37%. If I go to California, it's 21 plus 7, so it becomes 28%. And an S corporation distribution is 37 plus 13, or about 50%. So there's a huge potential tax saving arbitrage by using a more intelligent, more universal business structure. So he had a C corporation. We did the split dollar agreement. We had him sign it. I'm sorry. The split dollar agreement was done by a Los Angeles attorney. I submit it to the insurance company. The insurance company, that's a major company, says we can't use this document. You've got to use ours. I go, wait. This is one of the more successful and well-known tax attorneys in Los Angeles. We got to use ours. So I called the attorney on the phone and I said, I've got good news and I've got bad news. He said, what's the bad news? The bad news is they won't use your document. What? They won't use my document? Don't they realize? Blah, 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 blah. I said, wait a second, Lou. There's a potential advantage here. He said, what's the advantage? He said, well, the advantage is I'm not required to give the split dollar agreement to the insurance company, right? He said, right. I said, so we can still use your document. Except as far as the insurance company knows, this is a personally owned policy. And if they ever change the tax law, which they did about 4 years later, if they ever change the tax law, he's had non-deductible premiums paid with tax saving dollars, and that split dollar agreement just kind of disappears if you and the CPA are comfortable with that. That's what we did. That's what happened. That's a tax saving benefit to the client as well. Had the corporation purchase a disability insurance policy and take a deduction for the disability insurance policy, that goes against what the normal thought process is. If the corporation pays for it and deducts it and you don't take it in as income, then if you become disabled, lo and behold, all the benefits that come out of the disability become taxable income to you. When they changed the taxable process of the C corporation, we changed it and made him the owner personally. So now he did take the premiums in as taxable income in the hopes of getting a tax-free benefit in the future. So let's see. The results of the defined benefit plan is he was currently funding $30,000 a year. We increased that to $200,000 a year for 10 years, resulting in $85,000 of additional tax savings annually for 10 years. That's $850,000. The retirement plan accumulated to $3 million. We converted the defined benefit plan to a profit sharing plan for a couple of reasons. The doctor became disabled. He could no longer perform his services in doing surgery. We took $500,000 of the profit sharing plan, rolled it to a Roth IRA. It was his only income. We took the other $2.5 million and put it in the profit sharing plan and took it as a tax-free disability distribution. Another battle with the CPA. He doesn't qualify for a tax-free disability distribution. I say to him, I know. He said, well, why do you want to do that? And I said, because despite the fact that the tax code says that the disability distribution has to effectively meet the tenets of a Social Security disability, which is pretty much you can't do anything, that's not the way they adjudicate it. So we went to another tax attorney again, and the other tax attorney says, yeah, we do that all the time. So $2.5 million came out income tax free. Protecting the family, the Doctors Corporation purchased an own occupation disability policy. The doctor became disabled due to an accident, unable to perform operations at 55, collected from the disability policy. However, at age 65, the disability company said, we're going to stop making disability payments because we're going to reclassify the accident as a sickness. We recommended to the doctor was panic. I said to him, this might be the best thing that ever happens to you. He said, well, why? I said, well, here's an attorney. We're going to hire him because you're going to win this lawsuit. And what's going to happen is the disability company wind up settling for all back payments, all future payments for life, and 50% in punitive damages after attorney fee. Now, that doesn't happen if we don't have an ongoing involvement. He'd have just accepted it. Results from asset protection. Protected a portion of his asset from the claims of judgment creditors by implementing an ERISA-protected defined benefit pension plan. The vacation home was implemented by using some of the cash values in the split dollar plan, was able to purchase and remodel the $400,000 lake house, maintain and utilize the property for the past 35 years, and it's appreciated at $2.6 million. That's not a huge level of appreciation, but remember, he did it with tax deductible dollars. The recap of tax savings were the defined benefit pension plan, $100,000 a year for 10 years or $1 million. The split dollar plan, a tax saving annually of $30,000 for 5 years or $150,000. Distributions from the profit sharing plan, which were $2.5 million that saved $1,250,000 in tax. Grand total of tax savings, $2.4 million. This is one of the reasons that we're talking so heavily with our membership about the implementation of tax reduction plans, which we'll talk a little bit about later. But tax savings motivate people even today with the coronavirus hitting us, because there are still about 50% of the businesses that are open, and those that are open are actually generating more revenue than they would have before. There's still a unique opportunity despite the distraction of the pandemic. So tax reduction plans. Brad, why don't you talk a bit about those?
Yeah, tax reduction plans put our members in a situation where they can have a great opportunity to go back to their existing members or use for new prospects. But it's a pretty simple process, but it's very elegant in how it's applied. We have a team that puts together, we've got a form that's filled out that allows the member to be able to upload 2 years of their personal and corporate returns. They're reviewed by a specialist, and that specialist is a CPA, by the way, and it's a group of CPAs. But the specialist then goes and reviews all of the tax information and comes back with an amount of savings of unnecessary taxes paid. So, and then we've got some very complicated ones that are in the mix right now. I talked a couple weeks ago about a very simple one I did on a family in Texas, and I've got a couple more that are in the queue right now. But the client doesn't pay a fee to have that review done. What happens is once the review is completed, then the CPA sends the advisor an executive summary of what they've uncovered. In the very simple one I did, it was $34,000 a year in tax savings, and the fee was $7,800. So, over a 10-year period, the client saves $300,000, and it costs them about $8,000 to do it. In other words, if the client doesn't think that's a good trade-off, they haven't written a check to be able to have that review done. But what was really impressive to me about the first one and the other ones that I have in the mix right now or none of the recommendations were what I would consider to be exotic. Nowhere there did it say that the client should be taking out a captive insurance company. It doesn't say on there that they should be figuring out how to turn their swimming pool into an employee recreation area so they can write off chlorine in the furnace cost for the pool. It was all really block and tackle stuff, but it was missed by the CPA who they've worked with for the last 8 years. What we've done is developed a rapport that the CPA now has when you do plug the CPA in with the client. We're not trying to make their existing counsel look bad for reasons that we described earlier, but we're scripting it to let them know that that tax savings of $34,000 was phase one. Phase two would be through the corporations they own, how we could better come up with deductions that would allow them to pay even less taxes or reduce the taxation on their retirement income that they're about 8 years away from, or protect the assets, or pass along more money to the heirs on a tax-free or tax-favored basis through proper structuring. But what a wonderful thing to be able to come back. I mean, we've talked about it. Haven't had this happen yet where they came back and didn't have a very strong recommendation. I mean, I talked to the CPA of what if they go through the returns and it's $2,000 that they can uncover in missed deductions. I would just give the client that information. We're not going to see a fee attached to that, but it hasn't happened yet. But what a nice thing to be able to tell your client you have an amazing CPA or tax attorney, and I'd like you to introduce me to them, because I'm sure there's some clients that would like to have that level of counsel. It's a wonderful way. People like to hear they have good people around them. So it's a really win-win situation without the client having to write a check up front. So we are set up to do those now. I think we had 8 or 9 new ones put in just in the last 7 or 8 days, 6 days, Simon. So, people are taking advantage of that downtime with their clients and saying, here's a great way for me to get in front of them and offer a service, keep your name in front of them during these troubling economic times.
Yeah, and not everything about this structure is positive. I mean, for instance, we need to very carefully coordinate the conversation with their existing CPA, because we run the risk of embarrassing the CPA like we did with my client back in Ohio. And so there's a balancing act that has to be gone through with regard to including the CPA, explaining to the CPA how we can make this process available for them and other clients that they have, and they don't have to spend the time doing it. Our people will actually do it. They'll wind up with 20 to 50% of the fee as an additional revenue source. And to give you an example, one of the CPAs last year did 150 plans out of a practice where he has about $500,000 of gross revenue. The 150 plans developed $750,000 of additional revenue. It was $5,000 a plan. So it's something to give consideration to. We don't have to be an expert in the tax code. We don't have to be an expert in the plan. We just have to be an expert in learning how to make the opportunity available to the professional advisor and the end user client. You got anything else on that, Bradley?
No, that's about it. It's just we're, as we've said before, when we rolled this out a couple weeks ago, we're improving it on a daily basis. We've worked on scripting with the CPA so that we don't have conflicts in what's being said, and make sure the advisor is put in the best light for bringing this to the table for the client. But so far, it's been working even better than we had hoped. So we'll continue these tweaks and twists on it, and keep you updated, all you members updated on how you can use that tool, and make some money doing it for your clients as well.
And if you think about it, one of the big problems in getting people to move their assets or to buy insurance of any type is the budget. Where's the money going to come from? If you can sit there and save people money on their taxes, not just next April, but maybe on the next quarterly estimate, you have automatically created a budget. You've done a heck of a yeoman service for them. I've got Brad's name up there and contact information. I know most of you already have that, but I'm going to leave it up there and see if we've got some questions. Brad, I can't see them. Can you tell me what you got?
Yeah, Mike Schwartz wanted to know how I keep my hair cut during these times. I've got a can of Nair, so that helps. That keeps it nice and clean and shaved.
Yeah, thanks, Michael.
Yeah, thank you, Michael, for that. I had a bunch of questions, Simon, that we were able to handle electronically during the call. Most of them were related to getting their hands on the goals and objectives forms. We let everybody know that they can, those are up now on our site. Actually, goals and objectives are sent to the members as requested, but that matrix that we talked about today is now up in the member portal. So thank you, Bobby, for putting that up. I think it was Bobby that did that 3 minutes ago. Other than that, there really wasn't, that was a majority of the questions that came back in. So with that, I think we're probably pretty good here. It looks like we're right about on our hour.
Yeah, we're pretty good. We're probably going to do another webinar on a different subject, either Tuesday or Wednesday of next week. Guys, we'll let you know. And then Friday of next week as well. We might just continue doing this even after the pandemic stops, just because it's a way of staying in touch and giving you more information than just on a quarterly basis. Because doing things differently is not that easy. But as I said before, if you want the same results, then keep doing things the same way. If you want different results, you're going to have to make some adjustments. And these are not adjustments that are out of the realm of possibility. It's just new habits to be formed. Supposedly, it takes about $10,000 hours, excuse me, to create a new habit. So hopefully, we can help you through that and have you double or triple your production level. In any event, if there's nothing else, appreciate your time. We'll talk at you all soon. Take care.
Thank you. Stay safe.